Welcome to all of you in this new session. In this session, we will discuss the outstanding expenses and prepaid expenses. Outstanding expenses. Outstanding expenses refers to the expenses that a company has incurred but has not yet paid for. These expenses are typically recorded in the company's financial records as a liability, which means that a company owes money to the creditors or suppliers for goods or services that have already been received but not yet paid for. Example of outstanding expenses include rent, salary, supply fees, and other similar obligation. Outstanding expenses journal entry. Recording outstanding expenses when it recognized. Suppose on December 31st, 2024, Company A recognized rent due of rupees 1 lakh related to same year. However, the payment has not been made yet. The journal entry for the outstanding rent expenses would be rent expenses account debit to outstanding rent account rupees 1 lakh. Payment made in the next year. On January 10th of the following year, the same outstanding rent is paid in cash. The journal entry for the payment would be outstanding rent account debit to cash account. We debit the outstanding expenses account and credit the cash account. Remember, outstanding expenses are considered a liability and should be shown in the financial books to avoid overstatement of earning. Here we will discuss another expenses, prepaid expenses. Prepaid expenses, what is prepaid expenses? Prepaid expenses, we paid the expenses in advance. Recording as an asset. When a company makes an advance payment for insurance, leased office equipment, or estimated taxes, it records the prepaid expenses as an asset of the balance sheet. The asset represents the future benefit of company will receive. Gradual expense recognized. Over time, the value of the prepaid expenses is recognized as expenses into the income statement. Unlike regular expenses which are recognized immediately, prepaid expenses are allocated gradually across several accounting periods. For example, if a company lease office equipment for 12 months, the prepaid expenses is spread out over the entire lease period. Adjustment entry. To ensure accurate accounting, prepaid expenses entries recognized as expenses. Example of prepaid expenses. When recording prepaid expenses in accounting, we follow a specific journal entry. Prepaid expenses are payment made in advance for benefit that will be received in the future. Here, how you record them. Let's say on December 31st, 2024, Company A pays 1,20,000 in cash as rent for the next year, January 2025 to December 2025. Here, how the entry will be look. On December 2024, payment made for rent due next year. Rent account debit 1,20,000, cash account credit 1,20,000. On December 2024, we recognize that the rent that we paid in advance is not the expenses for the particular period. So it recognized as prepaid expenses. Rent payment in next year transferred to prepaid rent account. Prepaid rent account debit 1,20,000 to rent account credit 1,20,000. So if we do the analysis that on December 2024 we do not recognize the rent as expenses, we recognize it as a prepaid rent expenses. So we only did the entries prepaid rent account debit 1,20,000 to cash account. As we paid rent as advance, so in the next year from January 2025 to December 2025, we recognize the prepaid rent expenses as expenses in profit and loss account. So in every month we will do the entry as rent account debit for 10,000 to prepaid rent account for rupees 10,000. In February, similarly, we will do the same journal entry for rupees 10,000. Remember, prepaid expenses are shown on the asset side of balance sheet under the current asset head heading. Thank you very much for watching this session. Please like, subscribe, and comment below.